Welcome everyone, this is John Sheely as Director of Research and Development for IamADayTrader.com. This is the fourth video in our series of discussing the concepts and strategies that we will be using in IamADayTrader.com. What I'm going to try to do is to review what we've discussed in the previous three videos, as well as add an additional concepts. But as you know, we must review our risk disclaimers. Trading carries a high degree of risk, and trading may not be suitable for all persons. Past returns are not indicative of future results. Please review our risk disclaimer very carefully. Additionally, I place our hypothetical disclaimer as well. In IamADayTrader.com, we create a great amount of research in the creation of indicators and strategies. Like other research firms, we use hypothetical data to create our discoveries. Please review our hypothetical disclaimer very carefully. Okay, what I've done is show a price series, and we basically have changed from a bearish trend to a bullish trend. And we put a moving average or an exponential moving average, and prices begin to move through this area. Now remember, this is a zone of prices. Now this would be true generally in regards to either weekly or daily time periods, but the same would be true in regards to intraday charts. This area right here is where you go from one direction to another. And in this particular case, we use moving averages or exponential moving averages to tell us whether or not we are turning into a bull trend. And of course, we see these corrections that occur during the bull trend. And eventually, prices will begin to decline. And this zone is an area where you'll be understanding that this isn't a bull trend anymore. It is now a bearish trend. We will then have the potential of watching the declines in this bull trend as a correction. And that means that we have the possibility of putting on a long position, not just on the trend position. If you were long-term traders, or if you were trading as a trend follower in regards to intraday charts, then you would have found a position, a long position, because you believed that the trend was changing to a bull trend. And instead of taking profits here, you can just attempt to hold this trend as long as possible. But in order to do that, we need a correct average here so that you are not constantly tricked out of getting out of the trend position. However, what we're going to talk about here is swing trading. Swing trading does not care where the trend changed. All you want to know is the trend truly bullish, and should I have a bull bias? One of the ways you can make that determination is look at the slope of this moving average. It's constantly rising. That is a tool that you can use to tell you whether or not you are in a strong bull trend. And as long as that slope continually moves up, then you should have a bull bias. And since we have a bull bias, when we see a normal correction, then we will watch for corrections, a return in the direction of the bull bias, and we'll put a buy after we believe that the correction has ended. And then once we have bought this, we have some profit objectives. And as you can tell, you can do that again and again and again. So this is how you swing trade. First, is it a bull trend? You have already made that determination. Once that occurs, you have a bias. You wait for corrections, look for the corrections have ended, entered a long trade, a nice buy here, take profits, take profits, take profits, take profits. This is swing trading. And what we've done here, we'll look at MCD, that's McDonald's, and instead of an open, high, low, close, or a candlestick, I've used a line chart. And you can see it here. And this is a 50-period simple moving average. And you can see that we changed from a bull trend into this area right here, this zone, in which we changed from bull to bear. And we waited for corrections. And when we had an indication that the correction is over, you had the possibility of selling in regards to this correction and take profits when the trend continues in its bearish direction. And you could have seen that you had been able to do that several times. Finally, prices moved back above the moving average. By the way, you should not go long or short only based upon a single close above or below a moving average. No, you need more time to assess whether or not you've changed trend here. In this particular case, but as we're talking about here, you've moved up, you've gone to this zone again in regards to not we have changed from bearish to bullish, and this is where a lot of traders then would change their bias from a bearish trend and a bullish trend. And notice the slope of the moving average. It's beginning to change and it's beginning to go up. And that gives us confidence that we are now turning into a bullish trend. But notice that the trend was actually so strong that we've had these corrections, but it really didn't touch or get too close to the 50-period simple moving average. So we would look at a potential of a closer moving average or exponential moving average to see if it gives us a little better timing in regards to taking these trades with swing trades. Let me show you another chart so we can show this concept. Here I'm showing a chart of Intel. Again, it's a line chart, and this is the 50-period simple moving average. But as you can tell, we've had a great bullish trend here. Look at the slope of the moving average. But it's so strong that we've had corrections, all right, but it's rather pretty shallow. So how can I find the swing trades when the market is so strong? Well, we can use an additional moving average. And you can tell in the chart that's what we've done. We've added a exponential moving average just as an example. And what we've done now is put it real close to the price action. We don't want to be tricked out in regard to changing whether or not we're turning into a bullish or bearish trend. All we're doing is putting a additional moving average that's relatively close to the price action so that when we have these corrections, we could have these setups for a potential swing trade here. So you can see here that it's had enough correction. We basically have a condition of which we then will look for putting a long, a buy, and take profits if the market continues in the direction of the bullish trend. And so we could been able to do that again and do that again. But as you can tell, since we're talking about a daily chart here, after 3 or 4 months, it's probably due a change of trend or a large correction. And as you can tell, that's exactly what we've done here. So there's a reason that we have had one exponential moving average that's really close to the price in a very strong bull trend. We then have an additional moving average to give you a additional information in regards to whether or not we should have a bullish bias in regards to the bull trend. Now remember, does that mean we have to have a certain value of the moving averages? No. I'd talk about a 50 because it's very popular. But if you came to me and said, well, I like 52, 48, that's okay. The whole idea is to make sure that you're using a value that you're able to watch the price action so you can be reliably indicate that whether or not you have had a correct trend direction. We have a closer moving average, either simple or exponential, And this could be, I'm showing an example here of a 21. Does that mean it have to be 21? Could it be 21? Should be 30? Or what we're going to show you in our intraday charts, it could be a 34. And we'll talk about that now.